You're listening to Storage Nerds Podcast, where we unravel the best-kept secret of the real estate investing world, the storage industry. Join the grassroots guru in self-storage, Stacy Rossetti, in insightful discussions about finding, funding, and running these spaces, allowing you to yield the highest returns possible. Get your foot in the door on self-storage and discover how to properly purchase facilities, negotiate with sellers, and close the deal without worries. Start unpacking that investment wisdom with Stacy right now.
We are in the process of moving our offices, so everything is like totally like screwed up right now. I packed away my computer thinking that we were going to be able to move in immediately and just get everything all set up. But of course, that never happens, right? And so now like the internet's not working. And so I'm using like an old laptop and it's like not it's a fast laptop, but the computer, like the audio and the camera doesn't work very well. So just bear with me. I'm going to share my screen today and I'm going to go over one of the deals that one of my students just closed on. And then I'm going to show you like the deal analyzer and stuff like that. So just bear with me. And I appreciate you guys all hopping on. And listening to me. So for everybody that doesn't know me, I'm here every Wednesday. I teach. Actually, I was going to point out too that next Wednesday I have some friends coming into town, so I'm not going to be here next Wednesday. So just so you know, we're going to skip over 1 week, and then there's a couple of weeks during the summer that I'm going to be on vacation. So one of them is going to be next week. But yeah, so we had a student in Storage Nerds close on a storage facility last week. And it's actually his second facility. And I'm sure eventually one day he'll come on the podcast and he'll come and talk and tell the story. But I wanted to show you guys the process so y'all can see kind of how we worked through it. We found this deal in turnkey acquisitions for him. And then he closed on it. It took about it took from January until now to close on it. So that was like 5 months. All right, so it takes a long time to close things right now. It's just really taking a long time. So just, I keep telling everybody that like if you want to close on a facility this year, you better get your butt in gear because it takes a long time to find a facility and then close on a facility. I talk to people like, I want to close on like, 2 or 3 facilities in the year, but if you haven't already been looking and putting offers, then you're really not going to get something closed this year because it's just taking so long. I mean, banks are taking forever to close deals. They're just so conservative right now. And it's not a bad thing. It's not like the rates are bad or anything because the student that closed on this one, he got 8% interest, which sounds high, but honestly, the truth is like commercial real estate is expensive and even rates are always high. Like 6 to 8% is kind of a normal percentage rate. So, he got an SBA loan on this deal and he only had to put like I think it was 15% down and he got a fixed rate of 8%. And so I'll kind of go through that. I'll show you our process so y'all can see that. And so for everybody else that's listening, I apologize for not having like my video on, but it is what it is. And the show must go on, right? And for everybody that's new, I teach people how to invest in self-storage. I've got 16 self. I partner with a lot of my, not all my students, but a lot of my students, we partner together. And so we got a lot of deals across the country, and everybody is honestly really doing very well with their facilities. It's hard to own a facility. It's not easy. It's really not easy. And I don't want people to think that you can go out, buy something, and then like put a sign up, and that's just how it works. It's just not how it works anymore. There's too much competition out there. So if you don't want to play the competition game, then there's no reason for you to get into this. But if you're okay with kind of trying to figure all that out, then it's really a lot of fun, honestly. So like we had a person that just joined the facility owner mastermind last week, and they own one facility and they want to grow their portfolio out. And so we were talking to them in the mastermind yesterday, and this person like bought a facility 2 years ago, and they just haven't done anything really to get the thing leased up. They haven't raised rates. It's at like 80% full, but it's always 80% full. They never raised the rates. And they just kind of like thought that they could buy the facility and then just like make money. And it just doesn't work like that anymore. I mean, there's a lot of competition in the area. They have to really figure out how to manage that property. So that's why they joined the facility owner mastermind. And it was super fun to hear like everybody in the mastermind chiming in and giving advice on what they should be doing. One of the big things that they talked about was like their call center, and they're using the Zion call center right now. And I don't know anything about the Zion call center. So I don't know how good it is, but essentially I was telling them like, you need to ask for like they had not got ever like they had never gotten any like weekly reports or monthly reports on how the calls work. So like they had no idea in 2 years how many inbound calls they got, how many outbound calls, how many leads they got, how many customer service calls they got, how many conversions they got. I just couldn't imagine working with a call center and not knowing any of that stuff. And there are a lot of call centers out there like that. So that was one of the things we discussed yesterday in the mastermind. And you just got to be on top of whoever's answering your phone is going to make or break your facility. You just got to be on top of stuff like that. And so that is part of ownership. And a lot of people like they basically hired somebody to answer the calls and just kind of expected them to do all the work and like get the leads and stuff like that. And it doesn't work like that. It just doesn't. And just that meeting yesterday, we probably like if they implement what we tell them to implement, which I'm sure they will, they'll probably increase their income by like several $1,000s a month. And it just took them 2 years to really figure that all out. And so that's what the mastermind is for. So if anybody's listening to me and they're like, okay, I own a storage facility, but I know I could do better at managing it, but I'm just not 100% sure really what to do. Like you should consider joining the mastermind because that's where everybody will just chime in and tell you like, hey, you should try this. You should this is what we're doing. This is what we're doing. And then you can take all those suggestions and just implement whatever one fits your style or whatever. So it was really fun yesterday in that mastermind. But so yeah, and then last week we had a student, Rick. He closed on a facility. He bought the facility, I think, for like 2.5 million. And so it's for kind of a bigger facility, but I'm going to go over the numbers. I'm going to show you like what it looks like, and then just show you kind of our process. And then you guys can see how the deal analyzer is. So let me share this real fast. Okay. Do you guys see the Google Drive folder? Say yes in the chat if you see that, please. Okay. The Google Drive folder. Okay, good. Okay. All right. So this is kind of how we do it. This is like, so we found this facility and then we set the Google Drive folder. If you guys follow me, you all know how we do this, the same process, every single facility. And so this is the facility he closed on. It's called Brad Self Storage. And eventually I'll have him come and tell his story. But we found this story, so we put this Google Drive folder together. You can see Carmela is the VA that did that for him, and then what we do. This is everything that you need in order to decide if it's a good deal. So these are all the things that we kind of look at. We look at like we have to look at the Google map. Where is it located? The street view of it. We put all the demographics in, which is like household income and like population and stuff like that. You'll see all this in the executive summary. And then we have the regrid. I don't know if you guys know about regrid, but regrid is what we internally, this is what we use. And the reason why we use regrid, because it's free. That's why we use it. All right. It's not any better than anything else. But this is where you can look up the parcel data, right? And you can get the property report card. All you have to do is just go to map. And then once you do that, you can type your address in and it will show you like all the parcel data of your property. So we just put that into our executive summary, and it's got like all kinds, taxes and all kinds of stuff, what is it zoned as, this kind of stuff. Okay. And then we've got the county information, right? The county report card. There are all the competitors. and you know, what they look like. And then we've got the Radius Plus. Radius Plus is another software. I'm not going to get into it, but it's another software that you can use to look up information about storage facilities. So really, we don't really get into Radius Plus that much, honestly, because it does cost money. But every once in a while, we may need to get in there for some reason. But I would highly recommend getting in and playing around with it. And Radius Plus, I teach this in my boot camp, in my finding boot camp. But Radius Plus is a very good way to actually look at facilities that, you know, you can call, and you can ask the owners if they're interested in getting an offer. It's so funny. Like the other day, like one of my virtual assistants called an owner. I listened to the recording of the call. That's why I know about this. But like he called an owner, and the owner knew who I was. And they were like, "Oh yeah, Stacy. Yes, I know Stacy. Can you please tell Stacy to stop teaching people how to put offers in on facilities? It's annoying me so much. They're just calling me and they're trying to put these random lowball offers in. So tell her to please stop teaching people how to put offers in on facilities." That's what he said on the call. And I was like, man, I'm making a statement out there, aren't I? So, you know, on the one hand, I guess with owners, you know, they're getting frustrated because people do call and ask them if they're interested in putting an offer in, right? But on the other hand, why not get the offer? Like, what is the big deal about getting an offer and seeing what people value your property at? This to me, I don't understand this concept. I wish people would give me offers. I have 3 facilities for sale right now, listed for sale, and I still have yet to get an offer. Like, why don't people just put, even if the price is like way off, put the offer in so that you're like practicing this concept. I just don't understand how people don't put offers in, you know. But you guys put your 2 cents, what y'all are thinking. If y'all have anything to say about that, put it into the chat. But this is something that I push with my students. Make offers. It doesn't, I don't care if you're pissing off the owners or not, just make offers. Because you just never know. I mean, if somebody made an offer on my facility, I would do everything I could to create a win-win situation for both of us. And like nobody does. You know, it's scary, I guess, to put an offer in. Y'all tell me, why are you not putting offers in right now? Please tell me that into the chat. So anyway, so this is the Google Drive folder. And so you know, this is kind of what this is like. And then what happened is over time, I just got tired of opening up every single one of these folders and looking at every single one of them. So we created the executive summary. And the executive summary just takes all that information and just puts it into one document for me. So that's kind of what it is. And this is what, like most of my students, they're trained to make sure, tell me in the chat if you can't see this, but this is the executive summary. And you can see it says Brad self-storage at the top. This is what it looks like. You guys put your comments in too, like what you think about this facility, all right? You don't have to just sit there and listen to me blabble about everything, right? And so this is 35,000 square feet. So it's a big facility, right? You guys all know this is a big facility. And it's making $256,000 a year. And this is Carmela's executive. It's a beautiful executive summary. They get so creative in their executive summaries, right? You know, because they probably want a break from calling owners. And they're like, oh, let me just take some time and make this amazing executive summary, you know, and then get a break from calling all these owners. Because that's what they do. Like everybody on my team, they call, like they build their list in the morning and then they call in the afternoon. And if they happen to get somebody like that wants to get an offer, then they sit there and try to gather all the information to make the offer. And then they come up with this executive summary. So, okay, so this is the Brad self storage. You can see what it looks like. Kind of, you know, it's an older building, right? But it's not bad. It's in Lubbock, Texas. All right. If anybody knows anything about Lubbock, Lubbock is a secondary market, right? So it's one of those standalone cities that I talk about. You know, it's not in a metro area, and I don't know what the population is of Lubbock. Actually, we could probably look and see, but let's Google that. I always look up like populations of cities because it's good to know like what the population is. Storage is really heavily It's 263,000 people in just the city of Lubbock, right? And then like on the outskirts, there's also, there's like this, I call them sub-secondary markets. So it's like the little tiny towns around the secondary market, which are also very, very good areas to be investing in. Okay, so it's 263,000. This is the same size as Tallahassee. I live in Tallahassee. So this is kind of the feel. These markets, I'm telling you, are amazing markets to invest in because there's a lot of mom and pop owners, not a lot of big REITs are there. And actually, let's just go to Google Maps. Let's just pull this up here. So storage, uh, Lubbock. How do you spell Lubbock? Is that right? Is it Lubbock? Yeah, okay. Um, okay, so there it is. So you could see like there's no like major players in the city. I mean, there's like almost 300,000 people in the city, but there's no like major players. That to me is a very good market because I don't have to have them as competitors. Now, affordable storage and discount storage, they've got a couple of them here and stuff. So it's like, okay, those would be my competition. Like, how do they manage their businesses? How do they manage their facilities? I mean, obviously they know what they're doing, so I kind of look at that is what I do. But to me, like Lubbock is a great, great town to be investing in. So just as long as the price is right, obviously, but a good, very good buy and hold market. Okay, all right. So you could see here, Lubbock has this facility had two locations. He's just selling the one. 204. Oh no, sorry, you're right. No, it is. It's two locations. It's actually two locations, is what it is. So he's selling them together. That's what it is. So it's 241 units and then 76 parking spaces. The Upland facility is 101 storage units with 76 parking spaces. Okay, and then so that's kind of how it is. And then access acres, 0.78 on Upland, 2.2 areas. Okay. Vacancy rate 9%. All right, so it's full. All right, so it's doing good. It's full. Let's see here. What else we got? Annual income $175,000. Office 42. Okay, so there's some offices, right? You do not add when you're doing your deal analysis, you do not put the office income into the storage units. I see this all the time that happens. These are two separate incomes, and parking is actually a different income. So he has three different types of incomes coming into this facility. So you don't want to be mixing all the, you can't say, oh, it's $256,000 as the income, because storage, the price per square foot for storage is completely different from like office or parking. Like parking price per square foot is typically around like 20 cents a square foot, maybe 20 to 30 cents, depending on the location. And then the office is office like $1 a square foot. You know what I'm saying? Like typically around $1. And then storage could be probably around like 85 cents, it's 85 cents a square foot here. So like you can't combine all this together and run numbers on 256 because your numbers would be totally skewed. You have to run these three things separately. So that's why on our deal analyzer, you can run the units, right? And then you can run your parking separately and you can run other income separately. And that's kind of how you do it on our deal analyzer. So just be aware, like when you start doing deal analysis, that's what you're looking at. All right, that's what you're doing is separating this out because there's way too many times I see y'all are combining all that together and then numbers get all screwed up. Okay. The demographics you see are 260,000 people, only increasing, right? These secondary markets are like going to be the hotbed over the next 5 to 10 years, because all these bigger markets, they're all saturated. Like, who wants to move to these big, huge markets anymore? They want to have a place where you don't have to sit in traffic for an hour. Right. And that's why I left Atlanta, moved to Tallahassee just for this. Okay, so 260,000 people. The growth rate, all right, you can see is a growth rate of a little bit over 1% a year. Okay, so it's increasing every year. And then the radius is 3, 5, 10 miles. Okay, so population 44 in a 3-mile radius, 45,122, 272. Okay. And then this is the property information from Regrid, like I told you, the tax information and what it's zoned at and stuff like this. And then here's pictures. This is what it looks like. All right. This is the first location, 50th Street location. And let me see what else. This is, okay, this is the 5930 50th Street. So this is the office spaces. Okay. This is what he got. And so that's the office income. That's making 40 grand a year. And here's the storage. Here's the facility. This is the land parcel. It's fun to look at all this stuff. This is okay. This is the 7304. This is different. This is the second location. Let's see what this looks like. Okay, this is a little bit older units, right? It's got the double doors and stuff, but nobody cares about this. I'm pretty sure maybe they park vehicles in here. It's like enclosed parking. If y'all are from Texas, y'all like, this is a big thing in Texas, is like this enclosed parking. I have another student just got another one under contract that looks exactly like this. And this is where they park like their boats and stuff like this. Like, that's very, very big in Texas. It's like enclosed parking. Maybe because it's so hot. I'm not sure why it's so big in Texas. Y'all tell me. But I do see this quite often in Texas, these types of buildings. Okay, here's this facility. They've got storage and they got the bigger part in the bigger units. It's a little bit older looking, right? It's not too bad though. It needs a good paint job. But I mean, we just painted like one of our facilities last week. Looks amazing. Man, it only cost us like $2,500. No, it cost us like 3,000. We got a couple people to paint it for 3,000, a 10,000 square foot building, and it cost us $3,000 to paint that thing. And it looks amazing. And this is like covered parking right here. And let's see what else. Here's what it looks like. Okay, so this is, this is us just compiling everything into one executive summary. And here's the units. There's one, and then they're right next to each other, just like right up the street. But honestly, Lubbock, I mean, you can get anywhere in Lubbock like 10 minutes probably. That's the best part about living in Tallahassee. Okay, here's the competitor. So Secure Care is kind of a bigger second player competitor, right? You'll see a lot of Secure Care in like these secondary markets. In Monterey, you can see a lot of the buildings are older. Lubbock is a very old town, so a lot of stuff is going to be older. But Lubbock has a fantastic 20-year plan, and they're building out a lot of stuff. And actually, they're putting a highway around. Like they have one like kind of inner circle, like circle highway that goes around. I don't know what it's called. I can't remember. But then they're building a second one right now on the outskirts because they're planning for the growth that's supposed to be happening over the next 5 to 10 years. And that's something that you want to look at when you look at cities is, are you looking at their 20-year plan? Where are they planning to get the growth at if they are growing and stuff, And so Lubbock is very, very good at that. Some cities are not good at planning, but Lubbock is one of those that's very good at planning. Here's Easy Stop. A lot of this stuff is concrete. I've noticed here too. A lot of buildings are concrete. So maybe that was kind of a thing back in the day versus metal. Orchard Park is right here. Storage zone, these are metal. And then this is brick, affordable storage. This is the one that has the 3. So these are the ones that are competitors. This one has 3 facilities. So they have kind of nicer facilities. Okay. So that is what the executive summary looks like inside our folder. So now you kind of have an idea of what it looks like, right? So let's go to the daily analyzer. Let me figure out how to open this thing up. I just opened it. I mean, I just downloaded it. So hang on. You got some questions here too, I see. So let me just answer those. So I'm on like a laptop right now. So my husband convinced me, last year that I needed a desktop. And I moved from a laptop to a desktop. And I really like the desktop a lot better. Now I'm on this laptop. I can barely even move around. I don't know what I'm doing anymore. Okay, I see Heather saying, do I need to spend money on an inspection before I make an offer? No, we just make offers. No, just make an offer. You put your due diligence, let's just say you make an offer and they accept it, and you're like, holy crap, now what do I do? Like, what you do is you put it under contract. Either you can go out and look at the facility after they accept the offer. You can just be like, okay, I'm going to go take a look at it, or you can just put it under contract and have some due diligence time. And typically in the commercial world, 30 days of due diligence is like not unheard of, because we have facilities that, you're getting 60 days of due diligence, and sometimes even up to 90, depending on how big it is. So so you just need to put an offer in. That's it. Don't worry about all this other stuff. Just learn how to run deal analysis and put an offer in. And then you can worry about the next steps, like when that actually happens. Because the truth of the matter is, it takes like 50, if it takes 50 offers for one to get accepted. It really does. It takes a ridiculous amount of offers. Okay, so like just put some offers in. Okay, I can't read because I'm blind. When we find a facility, can we ask for owner financing? Yeah, right now the deal analyzer. That's the whole purpose of the deal analyzer. Everybody, all I just talked to one of my students. He got one under contract for, it's like 500,000, and then with owner financing, and all he did was just send over the offer letter. So yeah, I really push a lot of creative deal structures. Okay, like one of the students right now, he's doing like the owner. He's going to do $500,000 cash, and then $100,000 seller financing. Right. So he has like a couple of investors, and they're all partnering together. They have so much money. And then, but the owner really wanted 750, and they convinced him to do 600 with $100,000 of seller financing. And that said, that 100,000 is not paid until after 1 year of ownership of the property. So they're going to pay cash, $500,000 for the property, and a couple of them getting together, partnering together on the deal. And then the 100,000 they are going to pay a year later. They're going to start the owner financing for like 10 years. And he's like 5% interest for 10 years on $100,000. So that payment's like super, and it's interest only. It's like a super low. It's like super low. I think it's like $700 or $800 a month. So the truth is like you could negotiate any type of deal. There's no one way to do it. Okay. Okay, one more. Nice. I thought not nice. Oh my God, I'm so blind. Noel. Who do you recommend for skip tracing when looking for owners of properties? So we use Crexy to skip trace, but you can also use white pages. So let me just share that with you real fast so you guys can see. So Crexy, we have like the investors account. There's two different types. Like for Crexy, you think of like, I'm gonna just list my property and then go, make an offer on it, right? We don't ever make any offers on Crexy, honestly. What we do is we have the I don't even know I don't know my login, sorry y'all. Oh yeah, here it is. We have the investors account with Crexy. And so what that does is that gives you access to like all the data that they have. And they have like a ridiculous amount of data. I do not know how to use Crexy. I apologize. I'm horrible because I have a team that does all that. But all properties for sale. No, it's not all properties. Oh yeah, here it is. So the difference is that, yeah, you see you have comps and records. And then you have like lease comps, you have a whole bunch of like this does not come up when you don't like when you're in Crexy normally. And I don't know what else that is actually, so I apologize. But Crexy is where you can get owners information. Like you can actually get the email and the phone number of the owner in Crexy. All right, so that's what we do. Let's see. I can introduce you to Grant if you're interested in Crexy. Just message questions at stacyrossetti.com, and then I'll introduce you to Grant. He's our account person for Crexy, and then he can like do a demo for you and stuff like that. He's come on a couple times to the podcast as well, and so you can go back and to listen. You can listen to those if you want to. Let me see now. And then if you can't afford Crexy, because it does cost a little bit of money, then you can do White Pages. Right, White Pages is it's like the cheaper version, but you get what you pay for. Right. So whereas like in Crexy, you typically get, good information. White Pages, it could be good or not. All right. So just, try both. That's what we do. We try one or the other. Okay, now let me share my screen. Hang on. Looks like I got a couple more questions there. Does your student live out of the state, not in Texas? Yeah, so like one of our the one the student lives in he lives in Alabama. And so the one that he just got under contract in Texas, but he also owns a facility in Arkansas. He owns a couple in Alabama and then Arkansas and now Texas. I mean, we own 16 facilities. We live in Florida and we have 3 facilities in Florida and the rest are Georgia and Tennessee. Okay, so you do not have to be near your facility if you know how to manage it. That's why I said you got it. Like once you own the facility, you join the facility owner mastermind, and then you really start becoming good at managing it, right? So like that's the thing. And the hardest part of storage is not finding it and it's not funding it. It's actually managing it and actually making sure that you make money on the deal, right? Because you're buying a business. Everybody's like, oh, it's an investment. It's like, yeah, well, businesses are investments, but you're buying a business. You have to be able to manage it. Okay. And then Heather says, would you ever buy a facility in a flood zone? There's a 1% chance flooding every year. I think we do own facilities in flood zones. I mean, for me, it's not that big of a deal, but like for your first deal, I don't know, you just have to make sure what kind of a flood zone it's at. I mean, we live like in Florida. I mean, come on, like it's flooding all the time. And we have facilities in Florida. And the whole state of Florida is a flood zone, right? So, I have to tell you, like I have students that live like in the boot of Louisiana and own storage facilities there. So, to each your own, it just depends on your risk level. On a scale from 1 to 10, where are you on that scale? And that's kind of what kind of storage facility you're looking for, right? If you are a 1 on that scale or like a less than a 5, you should be looking for like income producing properties that are like inland, and they're in like good markets that are growing and like, maybe in like a secondary or, something like the secondary or primary market. And if you're like higher up, like we had somebody that applied yesterday to the program and he put a 10. If I would have filled out my application, I would have put a 10 right on mine. I'm a very risk adverse person. Like I just do whatever, and I just like to take, it's like gambling kind of a little bit, but some people are not like that. Some people just aren't. So on a scale from, you tell me, on a scale from 1 to 10, what number are you? Whatever number that you tell me, I can tell you what kind of deal you should be looking for. Okay, on average, how much does Crexy corporate account? I think it's like $150 a month or something. I think it's like around 150, but I'm not 100% sure. Okay, because I get the Stacy discount because I share it out and everything, but I think 150. Okay, let's do the deal analyzer here now. So now you can see Brad's self-storage. I'm going to share the deal analyzer with y'all so y'all can do it. I highly, highly recommend that you guys have the deal analyzer and like you're running numbers on it. And just it helps you to really run the numbers and make the offers. I'm going to make this a little bit bigger here so I can see it. Okay, so this is what the deal analyzer looks like. And you can get this, you can buy the deal analyzer on the website. Okay, just go to the stacyrossetti.com website and you can buy this. I made this public about a year ago. And I've seen like hundreds and hundreds of, I think a lot of people have used this deal analyzer to make offers and stuff. And actually, it's so funny. I got an offer on one of my facilities previously, and they used my deal analyzer and sent the offer letter in. I was like, this is awesome. I got my own offer letter, but it was like bonus points. Okay, so this is it. So this is Brad's self-storage. This is the deal analyzer. This is how we ran numbers and stuff. And so this is kind of when you're talking to an owner and you're like, okay, what do I ask this owner? What information do I need? Everything in yellow that you see on this info tab, you can see all the tabs at the bottom, but on the info tab is what you're going to be asking the owner. Okay. And so they need to know the market cap rate. So the market cap rate is based on the market, right? And I go over this quite often in a lot of videos and stuff, but typically you're like, it depends. Lubbock, they ran the numbers at a 6 cap is where they ran the numbers at. So Lubbock could be a 6 cap. Secondary markets are typically between 6 and 7 caps. And you know, primary market is maybe a 5 to a 6 cap, and a tertiary market is like a 7 plus, maybe 7 to 8 cap or something like that. You really don't find any cap rates higher than 8. A lot of people are looking for like higher cap rates. Like I have one student, he's adamant on buying like a 10 cap storage facility. And I'm like, you're never going to find a storage facility to buy. I'm sorry, those things are gone. You should have gotten to storage like 8 years ago when I got in, because everything I bought was like 10 cap or higher. But that doesn't happen anymore. You should be happy with like a 7 cap. Right. Otherwise, don't buy, because then that means that you're not like a 7, 8, or 9, or a 10, right? You're below a 7 on the risk level. And like maybe right now is not the best time to be buying. Okay. Okay. So the income you could see here is $174,000. That's just for the storage. So when you're running your numbers on this deal analyzer, like you're only running numbers on the storage facilities, right? 241 units, 35,000 square feet, 9% vacancy. So the storage is full. The other income is where we put it under this valuation current. So you can see the office is at 42,000, and then the parking was 40,000. So he not only bought a storage facility, but he also bought office space, and he bought a parking, like a parking lot. Okay. All right. And this, like what we do, like when we run our numbers, what we do is we look at it in three different ways. We look at like as is right now, this is what the numbers are. This is what the valuation is. And then we also look at like if it was not full, if it was like 25% full or 50 or 75%, and you have to do some work to get it filled up, what does that look like? What do you have to do in order to get it full? You don't really raise the rent until you like have it to 80, 85% full. And you know that, you know, you're not going to lose a lot of people by raising the rents and stuff. Okay. So we run the numbers at what we call potential, which is like getting them full, getting it full. Okay, that's potential. A lot of people think, what does potential mean? Potential means, is it full? If it's not, this is what you're going to do. You're going to just market the heck out of it in order to get tenants to come in. You're not going to raise the rates. You're just going to fill the thing up is what you're going to do. All right, that's step one. Now you can see here it's 9 to 8. We run our numbers on 8% full, right? So this is like almost there. Okay, it just goes up just a little bit from 174 to 176, just by that 1%. Okay, at the 45 cents a square foot. And then here's after updates is really kind of your opportunity. It's like, okay, if I raised the rents, if I added more units, if I added more square footage, what would the numbers look like? These are all the different opportunities that you could be doing to the property. Okay, so that's the three different ways that we evaluate our deals. So we're not adding units, we're not adding square footage, we're not increasing the occupancy. All we're doing is just increasing the rates from 45 cents to 66 cents a square foot. Where do we get the 66 cents a square foot? You get that from your competition analysis, your competitive analysis, okay? So as you can see here, all those competitors that you saw in the executive summary are all put here on the deal analyzer, and we are looking at the competitors. All right. So you can see here, like, and then we just do apples to apples. Whatever unit sizes that this or the facility that we're buying has available, we're looking at what the competitors are charging for those units. Okay. So you're filling out the info tab and you're getting this information, everything in yellow. These are just expenses down here. This is just your property taxes, utilities, expenses to run it. Okay. And then these are all formulas. So you can keep the formula if you want. These are based on our numbers. Or you can override it. You can be like, nah, Stacy's numbers suck. I'm going to change this. I can do it cheaper, better. I can be leaner. I have one of my students that was like, you know, because we run our numbers between like 35% to 38% expense ratio. And one of my students was like, man, I can do that at 27%. And I was like, well, run your numbers at 27%. You know, so like if you think you can do it better, change these numbers. That's why they're in yellow, so you can change it. All right. It's not gonna hurt my feelings. Okay, but if you don't know what the expenses are, just leave them here because this is a very good ballpark number. You know, they are good to start out with. These are numbers to start out with. And over time you can change them if you're better than us. Okay, all right, that's my 2 cents. Let me see what else. Okay, so this right here, I just went to unit mix. The unit mix is where you put the unit mix. All right, so you can see here that we're labeling like 10 by 10 by 15, 17, 19, 20. It's got all these kind of weird sizes and stuff. So we label all those out, 5 by 5s. And then we have the 12 by 5s by 25s. And then, so this is the total square footage. And this is the rent rate. Current, and then the competition, right? The competition is just coming from this page. So, these numbers are all coming from here. So our competitive analysis creates this number. So you can see current, we're at 45 cents a square foot. We're going to take it to 66 cents. And all we're doing is just taking the numbers from the competition, putting it here, and then adding it up here. Okay, so let me see. If I scroll all the way down, there's a lot of lines because sometimes you find storage facilities with like a ridiculous amount of sizes. So that's why there's so many. Like we've had facilities that have like 30 different sizes of units, so that's why there's a lot of lines. But you can see here 232, 35,000 square feet. And it should be making, right now it's making around $16,000 a month. If it was 100% full, it'd be around 16,000. It should be making around 23,000. All right, does that make sense to y'all? This is like could, right, is what it is. Okay. If you really wanted to get into like, physical versus economic occupancy, you could fill this out as well too. Okay, we didn't fill it out on this one, but sometimes we do. Uh-oh. Okay, so now we've got all the numbers filled out on the info tab. We have the unit mix tab filled out. We have the competition. Those are kind of the three big ones. If you don't have other income, if you do have other income, you're filling out your valuation current, potential, and then after updates. What you could do, like let's just say that you have on this current, we have 43,000 and 40,000, all right? You could say like, if I raise the rents on these two things, what could I make as well too? Could I get more than $1 a square foot? Or could I get more than 20 cents a square foot? Could I go up to 30 cents a square foot? So you can also increase the income on these as well too. Or you can change these numbers. So you could say, I'm going to start out at 40,000 and my goal is to get to $45,000 each on both of these, right? So you could change that number. Okay. And so that's how we kind of look at the numbers. Now, okay, all these are filled out. Now we need to put in our financing inputs, all right? And financing obviously is like the most important thing right now. How are you going to pay for this? How is this person going to pay 2.3 or 2.5 or 2.6 or whatever amount of money the owner wants? Okay. And so you have to figure that out. You have to figure out, how am I going to fund something like this? So you have to have this type of funding in your back pocket. If you get an SBA loan, you need 10 to 15% down. If you're going to get a conventional loan, you need 30% down. If you're going to have cash, you're going to 1031 exchange, you have cash or whatever it is, or you're going to get them to seller finance, right? So that's how we run our numbers. You can see cash, owner financing. There's 3 different ways. And then there's either bank or private lending, depending on your scenarios. These columns are nothing but calculators. I could put any name up there. I could put like Ooga Booga Booga, and it's the same thing all the way across. These are just 5 different calculators, and you get to run your numbers 5 different ways. Okay, so don't get all freaked out about like, oh, I don't have $2.3 million of cash or whatever. Basically, you're offering the owner like a cash offer, which is you either paying cash or going to the bank or getting a private lender to come in and give you the money, or you're going to seller finance it. You're going to do some sort of creative deal structure. And that's kind of how we set the tone for our offers, and we run the numbers that way. The one thing that I didn't point out is that on the info page, let me go up a little bit. Right, you see this little green box up here? This is how you can run the numbers in all the different ways. You can run 5 different scenarios. You just pick this, just pick the bank finance. He ended up doing the bank financing. So, but we ran the numbers, and you can see here, what we do is we really look at cash on cash return. We try to get around 10% or higher on the return for the cash, okay? That's our goal, 10% cash on cash return or higher. Whatever your goal is your goal, but like we try to get the cash on cash. So that here is here on this yellow line. Okay, so 10% is our target. Okay. So then that means like, so we come in and we start running the numbers and we just put, we run the numbers at 2 point, let's say if we do 2.6 million, oops, I don't know if I can do this, but let's see. I'm gonna screw it up. No, I'm not. Okay, so if at $2.6 million, it's 9% cash on cash return. And we always like, I tell all my virtual assistants, like it has to be 10% or higher for the offer. And so they always try to get it above that. So that's how we came up with the 2.3. We're just playing with the numbers and just running the numbers is what we're doing. It's super simple to get that number. But at the same time, over here, we need to get the cash on, like we need to get the return to 10%. Okay, so if we do 2.3 at 30% down and 10% interest by running this scenario, then it's a 7% cash on cash return. So then you're saying, okay, what if I get 8%? I mean, and typically you're going to get for conventional financing, you're going to get 30% down and 8% interest. It's kind of where it's at right now. So that's what you run your numbers at. You can see it's at 10% for $2.3 million. And then for the owner financing, we always try to do like, a little bit more. We try to entice them. We did try to entice the owner by paying more money for the seller financing. Okay. The way that bank financing works right now is that you have to get what's called the DSR. It's the debt service ratio. The banks want you to have this kind of spread. They want you to be able to make the mortgage. They want to be as conservative as possible. So we always shoot for getting this DSR at 1.3. So I'm going to scroll down here and you can see the DSR is right there. Right, so the DSR comes out at $2.3 million. The DSR is at 99.99. Right, and you want it to get to 1.3. So that means that this price might be too high for a bank. So this is why like deals are not working out if you have to go to banks. Because if I had to get this to 1.3, right, I'd have to be at like $2 million. Okay. And so then numbers just don't pencil out when you have to go to a bank. It's hard. Let me see, let's get over here now. It's 1.17, so it's even lower, you see? So that's why numbers are not penciling out right now because that DSR is so high, banks are so conservative. And this is one thing that we like, we try to discuss with the owners and explain to them as well too, is that like, um, the banks are being really conservative. Like for me to get to any number that you want, I need to have a 1.3 in order to get the number. So that means that I have to put some random offer in. I have to buy this thing at $1.8 million, right, to get it. So even though my cash on cash return, yeah, see now it's 1.32. So it's green. It says, yeah, it's a good deal. I'll do it. So because our numbers are based on that. But so now if you went to a bank right now and you had to put 30% down, 8% interest, and you had a balloon for 5 years over 20 years, like you would have to be at $1.8 million to make that number work for the bank. Even though your cash on cash is at 20%, the banks want this huge, massive spread is what they want to make sure that they're safe and you're safe right now. And so just because the interest rates are so high and they want a higher down payment, you do have this massive spread to make it work. Okay. Or you can shoot for like an SBA loan. All right. So I think let's do SBA loans are typically, let's see, your first time it's 15%, and then you're coming out to like 9% interest, I think, right now. They're about 9, maybe 9.5. He got 8. He got an 8%, but typically they're like 9% interest. So now you're at 26 and you're at 101. So even the DSR is not going to work with the 15% down. Okay. So then you have to say, okay, what am I going to be able to make an offer at for the bank to be able to do like such low payments? All right. So you play around with that. In the end, what our student did was not buy it for $23 million. He bought it for $2.3 million. He put 10% down and got 8% interest is what he got. It's a 10 over 10 loan. No, sorry, 20 over 20. He got a 20 over 20 loan is what he got. Okay. So he has to pay a mortgage of $17,000 a month. Right, something like, oh, sorry, $17,000. That's right. That's right. Yeah. And so that's kind of what he did. He just put 10% down with 8% interest, and then he got this thing for $2.3 million. He's okay with coming out of pocket every single month, right? In order to get the valuation of $4 million, right? So he has a $4 million valuation on this property. He bought it at $2.3 million. He put 10% down and he got it for 8% interest. Is what he got it for. Okay. So then you ask yourself, and the bank funded it. The bank was okay with funding it. So then you have to ask yourself on deals like this, are you okay with coming out of pocket a little bit every single month if you know on the back end that you're going to be able to make, $1 million or $1.5 million? You guys put in the chat what you think about that, right? So this person, his risk level is like an 8, a 9, or a 10. So he's like, yeah, I'll come out of pocket a little bit every single month in order to get this valuation up. I'll pay this, right? And you got to remember that his cash flow. So here's the current cash flow. He's making $256,000 a month. His expenses are coming out to around 95 or 97,000. So his NOI is at 150, and then he has his mortgage every single month that he's coming out of pocket on until he can get it up to his valuation. All right. And so he just plays with the number. He's a CPA. So he plays with the numbers until he can get it to whatever is working on this. Okay. But you could also offer seller financing. You could say, look, let's try to, if I give you 10% down or 20 or 30% down, would you be interested in financing the deal? Would you be interested in being the bank? And so our offers, right? Our offers look like this. All right, so this is the offer letter. It's just created right in the deal analyzer for everybody to know. But our offer looks like this. So it's either $2.3 million cash or $2.5 million owner financing. And then over 10 years, right, you're going to make around 650 to $1 million if you sell or finance it to me. And so this is kind of what you show. So you're showing your purchase price, your monthly payment, your interest rate, terms of the loan, down payment, the total interest to the owner, and then the net amount to the owner if they can sell it. Obviously the cash, which is, either paying cash or going to the bank, you're just getting this. If you can sell or finance it, you're getting this. Okay, so that's kind of how we show it. That's what opens up the conversation. I'm not 100% sure, honestly, what he ended up with on the final thing. But like, that's kind of like, we started out with something like this. And then then he went back and forth and did his thing. Whatever he came up with the bank and stuff. So I'm out of the equation for that, honestly. But that's kind of how it is. And this table here is like perfect to give to owners. This creates this awareness of like how much money they could possibly make, even if they sell or finance. I mean, either we're going to pay the bank this, or we're going to pay the owner this. I'm saying? Like, why don't we just pay you this? And then you don't have to do anything at all. And you get to save on your taxes because you're only having to pay taxes on the money that you make on a yearly basis, and you don't do anything. Over time, you'll make $1 million by not doing anything at all. Right? So that's kind of how we convince the owners to do that. Okay. And then you could also, you could play around with these numbers. I mean, all you do is think about these 5 columns as just calculators. Whatever it is, it's just a calculator. And then you just run the numbers based on whatever you can afford. What's your down payment that you can put down? What's your I know if you could put 20% down or 30% down, maybe he put 20% down, I don't know. But like if you put 20% down, what does your numbers look like? If you put 30% down, what does your numbers look like? So, and then the bank will say, look, I need you to, in order for me to lend you this money, I need you to put this much money down. This is a scenario that happened with one of our other students. Like she got it under contract for 550, and the bank came back and said, we can lend at 550 if you put $150,000, or no, if you put $200,000 down. And she only wanted to put $150,000 down, right? So like what they're doing is they're just coming up with that that debt service ratio. They're coming up with that spread, and which is basically called the loan to value. And then they just they come up with that scenario that fits their risk level the best. Okay, and you're doing the same thing on this sheet. You can change all these numbers to anything that fits your risk level, your amount of money that you have, and then you run scenarios to find a win-win situation for you and for the owner. Okay, that's kind of how it works on the deal analyzer. And then you can just print this and then send this offer letter over. And that's how we do. We just print this letter and just send it to the owners. Okay. That's the deal analyzer. So you can hop on to stacyrossetti.com to get the deal analyzer. It's a course, so it goes through and teaches you how to fill everything out. And then you have ways to make offers. You need to get out and make offers. Even if you don't get anything, at least you're practicing. You're putting offers out. If you're not putting any offers out, you're never going to get a deal. That's all I'm going to tell you. So you might as well just buy this and make some offers so you can learn how to do it. And then Heather says, can you do a deal like this if I don't have my own money to pay the difference every month? You just want to have it. You want to look for, if you don't have the difference, and find something where you're just breaking even or you're making a little bit of money, right? So there are a lot of facilities out there where you do have to come out of pocket, but there are facilities out there that are making income as well too. So you just have to find the right facility, okay? And then if you signed up for this session, you do get the replay. The only replay you get is the one that you signed up for. Okay. Where does he get the money to make the difference up? So he has no money. This guy, he's got money. So for him to come out of pocket a couple thousand, and that's what this is how I think. I'm like, okay, if I have to come out of pocket, let's say $2,000 or $3,000 a month for the next 2 years in order to stabilize this deal. That means that I'm coming out of pocket like $75,000, maybe $100,000 at the most. Am I willing to come out of pocket $100,000 over the next 2 years in order to make $1 million in the next 5 years? That's what I ask myself. Okay. Now coming out of pocket every single month is scary for a lot of people, but I mean, we have 16 deals, and this is how we do all 16 deals. Like I'm willing to come out of pocket. And the first one you're always really scared on, but then after a while, you start making money on the first one, and then you use that extra money to pay the second one off. And then it's kind of like this, I don't know what it's called, but it's like this cycle, So now all these facilities that we're making money on, we have a little bit, we use that money to buy, another facility. We just pour all that money into it. It kind of builds up over time, is what it does. That's kind of how we did it, but you don't have to do it that way. You could just buy an income producing property and then just make sure that you're cash flowing and that you can break even or make a little bit of money on the back end. Okay. And can you put it on a credit card? Yeah, you can put all your bills on a credit card. This is like if you're coming out of pocket, you're just you're just paying it's like coming out of pocket for the expenses. Like you can't put your mortgage on a credit card. But you can put your expenses on a credit card. You could pay all kinds of other stuff on credit cards too. Okay, so we put our stuff on credit cards just so we can get the points. That's what we do. Okay, all right. I appreciate you guys all hanging in to the end. Hopefully I'll see you guys at the next session. I apologize for my camera not working, but I'll see you guys. I'm not going to be here next week. I'm taking vacation, but I'll see you the week after, okay? All right, take care.
Thank you for joining us for this episode of Storage Nerds. Hope this informative conversation inspired you to go out there and jump into this highly profitable business venture that people rarely talk about. Get more tips on storage space investing at www.stacyrossetti.com. Don't forget to subscribe to the show and leave a rating. Together, let's build that thriving passive income one storage space at a time. Until next time.